Hi everyone. So in today's video we will discuss about stocks. What are stocks? How do you make money from stocks? What are different types of stocks and how do we create wealth using them? Also, you will see that what are the risks of investing in stocks? How is wealth creation done? And also how do you make money while you sleep, because wealth creation is a long term game. We have to be consistent, we have to stay put in the market, and then only we can make money in the longer term. I hope you like this video. So as we discussed, let's dive into what are stocks. Introduction to stocks. You see, a stock represents ownership in a company. It says owning a stock means you own a part of that company, which means basically that when you own a stock, you have ownership in the company. You become the business owner. Stocks are also known as shares or equity. So basically, when you have equity in the company, you become a owner of it, and that's why stocks are very important. While we do our jobs, while we are working towards anything that you are doing in your life, stocks will continue to perform for you. They will always be growing as the company grows. Investors buy stocks to earn returns through price appreciation and dividends. So it's a two-way win for everybody. You can appreciate the price, you can get benefits from appreciating price, and also dividends as you go. Now, why do companies issue stocks? To raise capital for business expansion, operations, or debt repayment. So we see due to these three reasons, companies issue stocks. How do they issue them? They issue them through an initial public offering or an IPO. You must have heard IPO in various news, or in various channels that you see that companies sell shares to the public. So when the IPO is happening, it's actually companies sharing, uh, selling the shares to the public. Investors provide money and return get part ownership in the company as well. So as investors, we have got uh, equity in the company by paying some amount of the initial public offer. Now, what are the types of stocks? There are certain types of stocks that we'll discuss over here. The first is common stock. You receive voting rights, potential dividends. Then preferred stock, fixed dividends, but no voting rights. Blue chip stocks, these are large established companies. For example, Apple, Meta, etc. Growth stocks focus on future growth, may not pay dividends. Penny stocks, these are low priced but high risk stocks. Most of the stocks that we have are common stocks. Then the most important, the one I believe everybody is waiting for, is how do you make money from stocks? Capital appreciation. You buy low and sell high. So let's say if this is an axis, x-axis and y-axis, you buy over here and you wait till the time the stock has gone up in value and you sell here. So let's say for example this was 100 rupees a share, as in the example you will see, and you sell over here at 150. So you buy 100 and sell at 150, so the 50 rupees is your profit, right? Now dividends, these are regular income paid by some companies which offer you a part of their profits on a quarterly basis. So dividends are always paid quarterly. Quarterly means 4 times in a year, right? Some stocks offer both growth and dividends. These are big companies, which offer you dividends as well, and growth in the capital appreciation part as well. That's what it means. Next, there are certain risks as well of investing in stocks. Let's have a look over here. Market risk. Prices fluctuate due to market forces, as we know. Then we have company risk. Then we have liquidity risk, and diversification helps reduce these individual stock risks. Now, let me explain each of them quickly. Market risk. So let's say stock A was trading at, you know, uh, let's say 100 rupees. Now, due to some market forces or some news, the stock went down to 80 rupees. Now, what happened? Your value of the stocks overall has decreased, right? Because you bought at 100, but the stock now trades at 80 rupees, which basically means we are at loss of 20 rupees per share. This is one of the risks, but we have to stay put if we have to build wealth for the longer term. Company risk. Poor performance affects stock value. Then if a company is not doing well, if for any reason the company has declined in sales, or the stock will the price or will also reflect the same in the stock. Now, liquidity risk. Now, difficult to sell low volume stocks. If there is a liquidity risk in a company, there will be low volume, like people will not be there to sell or buy the stock itself, and that's what liquidity risk actually means. However, we can mitigate these risks if we diversify. What that means is that you can diversify your stock portfolio into various sectors. You can take some stocks from the finance sector. You can take some stocks from even, let's say, retail sector. You can take some stocks from petrochemical sector. So all these sectors or all these industries have different stocks, and you can diversify your risk because if you have a diversified stock portfolio, there's a chance where your portfolio will do a bit better if you, rather than, for example, vis-a-vis invest all your money in one or two stocks. Now, how to start investing in stocks? Now we have covered the basics of stocks. What are stocks? How do you get dividends from them? And how do you get capital appreciation while you invest in them? Now open first a demat on a trading account. This is important because you will get electronically shares, electronic shares where they will be activated through a demat account, and you can open this. Second, choose a reliable stockbroker. For example, Zerodha or Grow, which are in India right now, and others as well. This is not any affiliation to any of these. It's just for educational purposes. Research companies before investing. It's very, very important. I can't highlight the importance of research on companies before investing. So because it's your hard-earned money, we always want to research on stocks and only then invest. Because as we do in other spheres of our lives, we research on a discount on anything we need to buy, any shirt we need to buy, or anything that we need to buy. Same goes for investing as well. If you research before investing, it's it's a good thing that we will get into a habit of researching, and then we could benefit from our research, so that we are not investing in a company which has liquidity risk or any other risk that we discussed earlier. Now, the fourth and important point is start with small investments and diversify your portfolio. If you start small, it will help you to build a habit of monthly investments or weekly investments, so that you build your portfolio the longer term. And as we discussed, diversify your portfolio as well. Now, in summary, stocks represent ownership in a company. Companies issue stocks to raise funds. Investors earn through price gains and dividends. Understand the risk before investing. And lastly, begin with research and a disciplined approach. I hope you like this video. I hope you liked the video. For more such videos, subscribe to my channel and let me know in the comment section what would you like to watch next.